All right, well, good evening, everyone, and welcome to week number 5 out of 6 for public budgeting. So we have tonight's session and we have next Mondays, and then our course officially ends then next Friday on July 1st. So we are almost there. Summer session goes by very quickly, and it's hard to believe we're on the cusp of July already, but that is where we find ourselves. So also a happy Juneteenth. Today is the official federal designated holiday for Juneteenth, even though it's June 20th. It's celebrated on Monday. The university hasn't really caught up with that as a no class day yet, so I'm sure they will in the near future, but that's the reason why we're all here tonight. Thank you for your posts in Beach Board essay number 3 and your discussion of those fiscal solvency indicators. I think everyone did a great job with that. And so not a whole lot of feedback to give you because I think that everyone selected a couple of those indicators and calculated them correctly. So it's really nice to have one of those tangible assessments that you can look at the class and say, well, this is something I can do now that perhaps I wasn't able to do when I entered the class 5 weeks ago. And I think that's something you can do now with this idea of fiscal solvency. Now you can read through a CAFR, you know the different sections of a CAFR, and you know how to assess that CAFR to then come up with an analysis of the fiscal solvency of your city. Again, with fiscal solvency, as we talked about last week, if you're really going to do fiscal solvency, what you would do is you would calculate those ratios, several of those ratios, either Brown's ratios or Dennis Wang and Tu's ratios, and you would do that for several comparable cities. And then you would compare where your city is, its ratio, compared to the ratios of those other comparable cities. And you put all that information together, you break your cities up into quartiles, and then you see where your city falls in the top 25%, bottom 25%, or someplace in that middle 50%. Clearly, what you're hoping to see from your city is you're hoping that the ratios from your city will place it in the top 25% for the vast majority, if not all, of the indicators of fiscal solvency that you choose to look at. But again, there's some very handy indicators that you can use to really come up with a tangible assessment of just how solvent your city is in comparison to other comparable cities. So I thought everyone did a real nice job with that. And so those have all been read, evaluated, and grades returned. Coming up this Sunday on the 26th, you have 2 assignments that are due. You have Beach Board essay number 4. It's a very straightforward type of assignment where you'll just be talking about the different types of long-term debt. So you'll take the information that we talked about tonight in the first half of class and tell me about some of the different bonds that are available to cities and the relative advantages and disadvantages of those different types of bonds. So it's Beach Board essay number 4 due next Sunday. And then also next Sunday, you have your post-instructional assignment that is also due. We've talked about it several times. So as you work on that post-instructional assignment, you put the finishing touches on it. Feel free to reach out to me via email if you have any questions. But just as a real quick reminder, on that post-instructional, it consists of 2 different parts. Part 1 of the post-instructional is you redoing those 8 questions from your pre-instructional assignment, but this time using all the information that you've received from the class. And so again, for example, in that fiscal solvency question, whereas the vast majority of folks in the pre-instructional answered, I don't have the information to answer this question, now you do, because you just did it in Beach Board essay number 3. So there should be answers to each one of those 8 questions using the information that you've gleaned throughout our past several weeks together. That's part 1, redoing the pre-instructional assignment. Then, as you know, part 2 is a construction of this budget for a new countywide library system or a consolidated countywide library system. And in part 2, what you'll do is you'll put together your Excel spreadsheet using that spreadsheet that I gave you, incorporating all the requirements from Form 56 in the Huddleston exercise. And you'll put that spreadsheet together, and then you'll provide me with the justification for the cuts that you made in creating that spreadsheet. When you provide me with the justification for your cuts, you can either do it directly on the Excel spreadsheet, or you can provide me with a separate Word file, whichever you are most comfortable with. But I do need to see a really brief justification for why you made the cuts that you made and why you felt those cuts are superior to other types of things that you could have done. So I'm assuming most people have been working away on that, and so you've probably made some pretty good progress on it. If you haven't yet, remember the first place you're going to start is with that Excel spreadsheet I provided for you, that line item spreadsheet. Add up what all the different branch libraries are currently spending, come up with that total, subtract 3% from that total. That then gives you your new target figure. So the new budget that you submit must not go above that target figure, 3% less than what's currently being spent by all the existing branch libraries. And then adhere to all those parameters that I showed you then in Form 56 in that Huddleston file. So that's your post-instructional. That is due next Sunday. I will work on grading those as quickly as I can and try and get those back to you within a day or two, so you'll have the score on that before we wrap up the class. And then on July 1st, you have your final 2 assignments due that Friday. You have Beach Board Essay number 5 that looks at taxation in your city, where you'll look at the tax structure in your city, make an assessment about how progressive or regressive that tax structure is, and offer some recommendations for maybe some changes in revenue generation in your city, different types of taxes you think your city should use, or ways in which you think your city should modify or revise its tax system. So that's Beach Board Essay number 5. And again, you'll get all the information you need to answer that in the second half of class tonight. And then also on July 1st, you then have that final assessment that is due, your responses to those 5 scenarios on that final assessment. Final assessment's available for you in the content area of our Beach Board site. So you've had the opportunity to have been working on that already, and you've got whatever time you need through July 1st to answer those questions. The rule of thumb on that final assessment is to be as parsimonious as possible, so be concise as you apply the information to answer those questions. Usually a paragraph or 2 is going to be sufficient for each answer, for each question on the final assessment. So be concise and be parsimonious. And then that's it. And as of July 1st, all your assignments are turned in. As of July 1st, we're all done. And I'll get your grades all calculated and hopefully available to you within a day or 2 after the end of the class. And you can then enjoy your July 4th weekend and move onward and upward if you have another class that you're taking in the next summer session. All right. So that's where we are. Tonight on our agenda, we're going to again do our class the way we usually do. We'll have 2 sections of the class. The first part of the class, we'll talk about debt management. Pick our discussion from last week. Last week, we finished up talking about capital budgeting, capital projects, and the reason why we fund capital projects a little bit differently than we do other items that are within an operating budget. And tonight, we'll start off talking about debt management and talk about the actual debt instruments that we use to finance those capital projects. That'll be the first half of class. We'll then take a break. And then the second half of class, we'll turn our attention to revenue generation. And we'll talk primarily about tax revenue, different sources of tax revenue, some of the evaluative criteria we can use to assess different types of taxes. And if time permits, then we'll also move into a brief discussion of revenue from non-tax sources. So revenue from things like user fees, user charges, and monopoly-based revenue sources. That's the plan. And so we'll see how we progress tonight. Again, it's a good bit of information, but I really would like to get all this done tonight so that for our last class session, we don't have a lot of heavy lifting to do. Next week, we'll just then do intergovernmental fiscal relations and call the course. So hopefully we'll be able to get through this information this evening. So without further ado, let's get into our discussion of debt management. And the way in which debt is used, especially at the local government level, state and local government level, is that debt is usually broken up into either what we call long-term or short-term debt. For municipal debt, we usually define long-term debt as being debt with a maturity more than 1 year. So it's going to come to maturity, it's going to be due to be paid off in more than a 1-year period of time. Typically, with short-term debt, we're usually looking at 1 year or less on the maturity. And sometimes these short-term measures can actually come to maturity very quickly. They might be 2 weeks, a 2-week note, or a 4-week note. And so they're much shorter in terms of their time span. So we'll look at long-term debt first. That's where we're going to spend most of our time. And then we'll also talk about short-term debt and the different instruments that can be used for short-term debt. But when these governments have these capital projects that they need to fund, They're not going to have all the money in year one. And we discussed this idea a couple sessions ago of intergenerational equity, that if you're going to construct a new recreation center, you know that future generations are going to be gaining a benefit from using that recreation center. So it's not fair to tell people who live in the city in year one, you have to shoulder the entire financial burden of constructing this recreation center. And then all the people who come after you, who will be using that center and getting a benefit from it, they don't have to contribute to the cost of building it. So for purposes of equity, what we'd like to do is we'd like to spread the tax out over a long period of time, spread the repayment out over generations, so that even people who move into the city 10 years or 15 years from now will still be repaying that debt so that they can do their part toward paying off the debt incurred from the construction of this new recreation center. And also it protects our taxpayers, that if you have a $60 million recreation center and you have to raise $60 million in year one just by increasing taxes, that's going to result in an exponential increase in tax rates. So instead you issue debt, and then you can repay it over a 30-year period of time, which then gives you much smaller tax rate increases that are much more acceptable and much easier to handle for your taxpayers. So there are good reasons to use long-term debt for our capital projects. Traditionally, one of the more common types of long-term debt is what was called a general obligation bond, referred to as a GO bond, general obligation. This used to be the most common type of bond that was used to fund capital projects. Now, its popularity in recent years has kind of tailed off a bit because governments have really gotten creative in terms of coming up with different types of financing mechanisms to try and give them more flexibility and save them a little bit of money. So general obligation bonds aren't the only type of bond. In fact, they're not the most common type of bond for a lot of governments to use today. But historically, they've been a very common type of long-term debt instrument. With a general obligation bond, there are good aspects and there are negative aspects as well for governments. One of the negative aspects for governments is that a general obligation bond will pledge the full faith and credit of that government to repay the debt. It's an unconditional guarantee of payment. So what the city is saying when it issues a general obligation bond is we will pay off this debt. We will repay the investor who purchases this debt. And those investors who purchase your debt could be a variety of different types of investors. You can have what we call mom and pop investors. And mom and pop investors are just individual citizens who purchase general obligation debt, invest in general obligation debt to earn some interest. You can have funds that can invest in general obligation debt as well. Other governments oftentimes invest in general obligation debt. General obligation debt that's issued by the national government is frequently purchased by state and local governments because it's a good, secure type of investment where you know you are going to get your money back. So the city guarantees that their investors will get repaid no matter what. So what the city is doing is it's saying, we will do whatever we need to do. If we need to raise taxes, we'll raise taxes to pay back this debt. If we need to lay people off or fire people, RIF them to a reduction in force, we'll do that in order to repay the debt. If we need to liquidate some of the city's assets in order to repay the debt, we'll do it. We'll do whatever needs to be done to make sure the investor gets their money back from investing in this general obligation bond. So for the investor, that's a great thing. It's a very secure type of investment. For the city, it's not, because it means the city is going to have to bend over backwards to repay the debt. They can't say, well, we use this debt to build a recreation center, and you know what? The recreation center went belly up in 5 years, and so therefore we don't have to repay the debt. And that doesn't work that way. You still have got to repay the debt no matter what. The nice thing for cities with general obligation debt is, if you do any investing on a personal basis, that there's this relationship between risk and return. That the higher the risk, the higher return you're going to expect as an investor. The lower the risk, the lower the return you're going to get. Well, this is a very low risk investment for an investor because the city is going to pay your money back. So that means you're going to get a very low return with a general obligation bond, which saves the city money because what we call the coupon rate, and with bonds, interest rates are referred to as coupon rates. And it's just the way you do it with bonds because in the old days with a bond, if you were an investor, you'd purchase a bond and then you would get a payment book. And every month that you would do a payment, you would rip off a coupon and you would mail that coupon into the government, and the government would then send you a check for your interest payment. Hence the reason why it's called a coupon rate. But a coupon rate's an interest rate. So governments get low interest rates on general obligation bonds, which saves them money and makes it a relatively economical way for governments to borrow money. Another nice thing about general obligation bonds is they're not only cheap for government to use, but they can also be used for a wide variety of different types of projects. And so typically we see GO bonds used for buildings, rec centers, city halls, a new police building. We use a lot of general obligation bonds to construct and reconstruct roads. We use them in criminal justice for jails and prison construction. We use them in education for the construction of schools. You can really use it for a broad variety of different types of capital projects. But even though general obligation bonds used to be by far the most popular type of bond used to issue debt, now they make up less than about a third of new bond issues by local governments. And the reason for that is because local governments have gotten creative in coming up with different ways of funding capital projects that kind of limit their exposure in terms of repaying the debt. So other types of bonds that don't have the same unconditional guarantee of repayment that you would have normally had with a general obligation bond. Another reason why we've seen cities go and start using other types of bonds is because general obligation bonds are subject to state limitations. And so every state will place a limit, what's called a general obligation debt margin on local governments to limit the amount of general obligation debt they can issue. A typical general obligation debt margin is about 3%. So what they'll say is you can only issue general obligation debt up to a value of 3% of your assessed valuation in your jurisdiction. Because the assessed valuation of property in your jurisdiction, that's a direct indicator of your capability, your financial capability or capacity. So you can only issue up to 3%. And so you're limited in the amount of general obligation debt you can issue. There are some other types of debt we're going to talk about in just a second that are not subject to those types of state limitations. Another reason why we've seen governments move away from general obligation bonds is that general obligation bonds typically require voter approval. And in a lot of states, not only do they require voter approval, but they require a supermajority voter approval. So in a lot of states, including California, certain types of general obligation bonds will require a 2/3 voter majority in order to be able to issue that general obligation debt if it is above the state imposed limitation. Now, not all general obligation debt requires a 2/3 majority. Here in California, we have a constitutional provision known as Proposition 39. And you're probably familiar with this, but the confusing thing about California, we like to amend our Constitution a lot, and we also like to reuse numbers. And so propositions, constitutional initiative propositions, we will reuse numbers over and over again. So there's more than one Proposition 13. There's more than one Proposition 57. And there's more than one Proposition 39. But Proposition 39 here in this context was a constitutional provision that allows local education agencies, such as school districts, to issue general obligation debt with only 55% voter approval, as opposed to the normal 2/3 voters to approve. So you only need 55% in order to pass a general obligation bond if you're a local education agency. However, you only need 55% of your voters. And in my district back in 2014, we passed one of these and we got, I think it was 58% voter approval. So it was pretty close. But in addition, you only need 55% of voters. But if you're going to use a Proposition 39 general obligation bond, you then also have to set up an oversight committee, a citizens oversight committee that will then conduct regular audits of how the bond proceeds are being spent. So, there are a lot of nuances in California law that will govern different types of bonds, but for the most part, general obligation bonds, you have a unconditional guarantee of repayment, but the coupon rates tend to be relatively low and can really save states, because the local government's a lot of money, but they are also subject to state-imposed limitations on the amount of general obligation debt that you can carry as a local government. So because of some of those drawbacks, we've seen governments move away from general obligation bonds and replace them with some other types of bonds. The second type of bond that can be issued is what's called a revenue bond. And the big difference here is that whereas a general obligation bond is repaid with a full unconditional guarantee of repayment by the local government, the local government will use whatever resources it needs to repay the debt. Revenue bond repayment is secured specifically from the earnings of operating the facility that's being constructed with the revenue bond. So if you're constructing a facility like a recreation center, and you're going to be generating revenue every year from charging people a membership fee for using the recreation center, you can capture that revenue and then use that revenue as the guarantee of repayment. Now, obviously, that's not an unconditional guarantee of repayment. And so if you're an investor and you're purchasing a revenue bond, you are not nearly as confident you're going to get your money back as if you were to purchase a general obligation bond. So there's more risk. As we know, more risk means more reward for the investors. So investors will expect a much higher coupon rate, a much higher interest rate if they're purchasing a revenue bond as compared to a general obligation bond. And also, if you do want to issue a revenue bond, you need to make sure that the facility that you are constructing will generate an adequate amount of revenue to not only cover its operation, but also to repay this debt. And so you're going to have to be generating a good bit of revenue in order to be able to use a revenue bond. Some of our projects don't generate revenue. If you're going to construct a city hall, it's going to be kind of tough to use a revenue bond because there's not a whole lot of revenue coming in from the city hall. I guess it is possible you could rent some rooms out in city hall after business hours, but it's kind of unlikely you'd be able to generate enough revenue just by renting out a few rooms to secure repayment of the debt. And when we say debt service, we're talking about repaying the principal and the interest on that debt. So those principal and interest payments you're making, that's what we refer to as being debt service. The good thing about revenue bonds is that they are usually exempt from state-imposed limitations. And so if you're a city and you're bumping up against your general obligation debt margin, you're bumping up against that limitation imposed by the state, you still need to issue debt, and the facility is going to generate revenue, you may want to consider a revenue bond. But as we'll see in a couple of minutes, if you're issuing revenue bonds, there are a lot of what we call covenants that need to be attached to those bonds, a lot of promises of what you will do in order to make sure the investor gets their money back from investing in this revenue bond. There's also a question with revenue bonds in terms of the interest being exempt from federal income taxation. Now, whenever governments go out there and issue debt, their municipal debt is competing against corporate debt because corporations borrow money as well and issue debt. The problem is that the return on corporate debt for an investor is usually much higher than the return on any type of government debt they can purchase. The government debt is a bit safer, but the return is going to be a lot lower. So in order to effectively compete against corporate debt, what governments need is they need for their debt to be tax exempt. And so with a general obligation bond, for the most part, if it's a public purpose general obligation bond, for the investor, the interest that investor earns from purchasing that bond will be exempt from federal income taxation. So that's a big perk. That's a big benefit for investors, that all this interest revenue they're getting is going to be exempt from federal income tax. That's true for public purpose general obligation bonds, but it may not be true for revenue bonds. It depends on how those revenue bonds are being used. And we'll see in a couple seconds on a follow-up slide In 1986, Congress created two different categories of government debt. There's public purpose and there's private activity. For all intents and purposes, public purpose debt, the interest earned on that debt remains exempt from federal income taxation. Private activity debt, though, the interest earned is subject to federal income taxation. So it can become more difficult to try and sell this debt to investors because they no longer have that tax exempt status. But it's an option if you don't have the ability to issue general obligation debt. But it is going to be more expensive because the coupon rates are going to be higher since it is a riskier type of investment for an investor. You can combine the two together and try and get the best of both worlds with what's called a double barrel bond. Double barrel bond, a certain percentage of the bond will be general obligation in nature, certain percentage will be revenue in nature. It provides the security of a general obligation bond without the associated unconditional guarantee of repayment. So if you are funding a project that will generate revenue, so you know your recreation center is going to generate revenue, but you're not convinced it's going to be adequate to cover operating expenditures as well as repaying principal and interest, then you may want to do a double barrel bond. So that part of the repayment comes from that revenue that's being generated, but part of the repayment is going to come from other governmental sources as well. In terms of coupon rates, double barrel bonds are going to fall right in between general obligation and revenue. So general obligation is the cheapest type of debt to issue. Revenue is going to be expensive. Double barrel bond is going to be right in the middle between the two. So investors might be more willing to purchase a double barrel bond than a revenue bond because they don't have the same risk exposure that they would have purchasing a revenue bond. And there are lots of different types of bonds. We don't have the time to go through all of them, but another one I'll highlight for you is what's called a special tax bond. In a special tax bond, you will use a specific type of tax in order to repay the debt. So, for instance, when we talked about assessment districts, and we said you want to put streetlights in this neighborhood. So you make that neighborhood an assessment district, and then you will levy a increased ad valorem property tax on those houses within that neighborhood, then capture that tax revenue, and then use it to repay the cost of the streetlights. That would be an example of a special tax type of bond. We are capturing that additional property tax increment, and we are then using it to repay the debt. Obviously, it's going to be weaker security and not as good of a bond rating as with a general obligation bond. You're going to have a higher coupon rate that you're going to pay with a special tax bond than you would with a general obligation bond because it's not an unconditional guarantee of repayment. And as we go through our discussion, you're going to see that there are other types of bonds as well. We're going to talk about things like zero coupon bonds, capital appreciation bonds, and some interesting variations that we have seen California governments use to, again, get around having to use only general obligation bonds. But one of the big questions, again, with government debt is it really behooves the government to try and keep their debt tax exempt so that investors don't have to pay income taxes on the interest they're earning on the debt. It makes it much more competitive with corporate debt, and it allows them to issue their debt a lot cheaper because it's going to be much more attractive. The more attractive the debt is, the better deal you're going to get issuing that debt. The problem, though, is that governments for decades kept getting more and more creative with the way in which they were constructing and issuing debt. And we saw a lot of governments using what were called industrial development bonds, or sometimes just known as IDBs, industrial development bonds. And the purpose of industrial development bonds was to try and lure businesses into your jurisdiction. So you wanted to attract businesses in your jurisdiction to increase your corporate property tax base. So you say, we'll use this bond to build the infrastructure for you to conduct your business. So we're going to use the proceeds of this bond to build a business park. And we'll put in all the infrastructure you need. We'll run the electricity. We'll put in the street lights. We'll put in the drain system. We'll put in the water system. we'll put everything in. So all you need to do is just kind of move in and move your business here. Well, that's obviously very attractive because you get a brand new building, you get all this infrastructure provided for you. So you're probably going to move your corporation to that jurisdiction. The problem, though, was that the proceeds from the bond are being used to benefit a private activity, to benefit a private business. And so governments are doing that a lot. And Congress kind of wised up to it, and Congress decided to put an end to it. And so they finally put an end to it with this thing called the Tax Reform Act in 1986. Now, the Tax Reform Act was a huge piece of legislation that most notably fundamentally changed our federal income tax system. It changed our tax brackets, it changed the marginal tax rates, just a complete overhaul of the federal income tax structure. And that's what most people think about when they think about the Tax Reform Act. But one part of the Tax Reform Act that's germane for us here is the part of the Tax Reform Act that created two different types of government debt. So Congress created what was called a public purpose category for debt and another one for private activity debt. For public purpose debt, that's debt that remains tax exempt because it's being used for the purpose of government. So something, you're building a city hall being used directly by government, there's really no private activity going on there. That's public purpose, that remains tax exempt. However, they came up with a definition of what they consider to be private activity debt. So private activity debt's defined, and you don't have to remember this definition. I'm not going to test you on this definition, but that's defined as if more than 5% or $5 million of the bond proceeds are being used for loans to non-governments, businesses or anything that's a non-government, or more than 10% of the proceeds are used by non-governments in business, and greater than 10% of the debt service is secured or derived from payments from these non-governmental entities. So essentially, it all boils down to how much of a role is the private sector playing in repaying this debt or getting the proceeds from this debt. If you exceed those thresholds established under law, then that debt is going to be considered to be private activity debt. And if it's private activity debt, then it is not necessarily tax exempt. What the law also did is it placed a cap on the amount of private activity debt that could remain tax exempt. And that cap that was placed is $50 per capita, $50 per person, or an overall cap of $150 million. And that was in 1986 dollars, and so it's been indexed since then, but you place this cap. So what you ended up having then is local governments are competing against each other to get their private activity debt included within the tax exempt cap. If you got included in the tax exempt cap, then you'd have an easier job trying to sell that debt because it'll be much more attractive to investors. If not, then the debt becomes much more expensive for you to issue, and then the city would have to really make a difficult decision as to whether or not it was worth actually issuing that type of debt. I say Jay in text chat asks what kind of what Walmart does when it promises to put in a solar super center, leaves after 10, and after 10 years, Walmart leaves, gets free water, land, electricity. Yep, and that's happened to a lot, and that's a great point. That happens to a lot of municipalities. You know, they'll put all these resources in to attract a company to come. That company comes and gets a tax abatement, and in the second half of class, we'll talk about tax abatements. We'll get a tax abatement, so we'll get his taxes forgiven for a certain number of years, and then a few years down the road, gets a better sweetheart deal from another state or another jurisdiction, packs up, and then moves out of town. That's leaving that facility empty. That's happened to a lot of jurisdictions, and so jurisdictions have worked really hard to try and lock these companies into long-term types of deals where the government will say, we're going to still own all of this and we'll lease it to you, but we'll require, if you want to get this tax abatement, we're going to require that you stay here for 10 years or 15 or 20 years or whatever the case may be, because this happens a lot. And it's really in the best interest of the private company to do this. It's going to benefit your bottom line to get all these free goodies and then move out when you get a better deal someplace else. So you're exactly right. That has happened, and a lot of governments have gotten burned with that. And so Congress really tried to put a limitation on that in 1986. The problem, though, was when Congress did this, state and local finance officials, for lack of a better term, lost their minds. They freaked out over this, and they said, well, this is the beginning of a slippery slope. That now Congress is going to eventually take away the tax exempt status for all debt being issued by state and local governments. And so we then had a follow-up lawsuit, and South Carolina versus Baker 2 years later, which was a lawsuit to challenge the constitutionality of the Tax Reform Act. And the Tax Reform Act was challenged on the basis of this thing known as reciprocal tax immunity. For many years in this country, we had this principle of reciprocal tax immunity that goes all the way back into the early 1800s. In the early 1800s, there was a case called McCulloch versus Maryland. And the McCulloch versus Maryland case, we had a situation where the Congress had set up a national bank of the United States. And for this purposes of this case, there's actually a rechartering of it into the second bank of the United States. So it was a federal entity that was located in these different states. And the federal bank had locations in the state of Maryland. One of the locations was in Baltimore, Maryland. The problem was that the state of Maryland had a state law that allowed Maryland to tax all the notes issued by financial institutions within the state. So in accordance with the state law, the state of Maryland started taxing the notes being issued by the branch of the second bank of the United States that was located in Baltimore, Maryland. Well, here's a question about, can a state government tax the federal government? Went all the way up to the Supreme Court in McCulloch versus Maryland. Justice Marshall made the argument that the power to tax is equivalent to the power to destroy. That if we allow one level of government to tax another level of government, that's equivalent to giving that government the power to destroy that other level of government. And so that established a precedent whereby governments couldn't tax other governments. And so, still today, if you've got a state university that's located within a city, the city doesn't apply its property tax rate to those state holdings because they're two separate governments. And that's a pretty strong principle, long-held principle that over the years started to erode a little bit. But once we get into the Tax Reform Act, now you're saying, well, we can tax these types of bonds that are being issued by local governments. We can make them subject to the federal income tax. Well, state and local officials said, no, you can't. That's a violation of reciprocal tax immunity. It's a violation of the precedent that was established in McCulloch versus Maryland. So you can't do this. Took the case to the Supreme Court. In South Carolina versus Baker in 1988, the Supreme Court said that interest earned on state and local debt is not necessarily tax exempt. That if Congress wants to make it subject to the federal income tax, Congress has the constitutional ability to go ahead and make that interest subject to the federal income tax. Well, if you thought that state and local finance officers lost their minds after the Tax Reform Act, you should have seen them after this court case, South Carolina versus Baker. They became completely convinced that this was the end of tax exempt status for any debt that was being issued by state and local governments. At the time that the Tax Reform Act was passed, one of the principal architects of that Tax Reform Act, Floyd Benson, made the argument that don't worry about it, we're not going to do it. Congress may have the ability to do it, but we're not going to go down that slippery slope. And still today, public purpose debt still remains tax exempt. It's only if it falls in that private activity category that it may be subject to federal income taxation. Let's see, I see Jonathan has Anaheim raised a lease revenue bond. Those are interesting types of bonds too. We can talk about those in a couple of minutes as well. But raised a lease revenue bond in 1997, $510 million to pay for the Disneyland parking structure. How's that apply to the Tax Reform Act? Chances are, if it's a lease revenue bond and it's benefiting a private activity such as Disneyland, it probably would fall under the private activity category. Now, if it was something that was deemed important enough Part of that may have then been subject to the exemption and may have gotten a state exemption, and to keep it tax exempt, at least a part of that up to the state imposed cap. But chances are at least part of that would be considered private activity and probably would be subject to federal income taxation. Now, again, those amounts from the 1986 Tax Reform Act, those have been indexed over the years, and so those caps have grown, and so they're larger now than they were when they were established back in 1986. But for the most part, if it has some private activity element to it, you're going to have to make a compelling argument as to why that interest should still remain exempt from federal income taxation, which is a big change from the way in which it was after McCulloch versus Maryland, where as long as the government was issuing it, it was considered tax exempt. So all those industrial development bonds that we had talked about earlier that were being issued throughout the 1900s, those were all considered to be tax exempt, even though they had a direct private activity purpose to them. They were all still considered tax exempt. It really wasn't until 1986 that Congress really dropped the hammer with this duality of public purpose versus private activity types of debt. But it's a valid concern for state and local governments to have, because once you have lost that tax exempt status to interest earned on the debt, you have lost your foothold in the market. And now it's going to be much more difficult for you to compete with much more attractive return rates that investors can get from that type of corporate debt that you are competing with. So you're not only competing when you issue debt with corporations, you're also competing with other governments, because other governments are going out there and issuing debt as well. And so everyone wants to make their debt issuance as attractive as it can possibly be to win over investors. One of the ways you can make it more attractive is by having a good credit rating. Now, just like we have credit ratings in our private life, governments get bond ratings as well. We'll talk about the bond rating process in a couple of minutes, but the bond rating will dictate how expensive it is for you to issue debt. The worse your bond rating, the higher the coupon rate you'll have to pay and the more expensive the debt will be. So it's important for governments to try and enhance their credit profile as much as possible to get the highest bond rating they can possibly get. Unfortunately, for some governments, their credit profile is not great. And this is especially true for places like New York City, my hometown of Cleveland, Ohio. Orange County ran into this problem as well a couple of decades ago, where they had very poor bond ratings. So it made it not only expensive, but sometimes next to impossible to issue debt. So what they would do is they would engage in what's called credit substitution. And there are three basic ways in which you can substitute a new credit rating for your current credit rating if you're a government. One way to do it is through what's called a letter of credit. This is literally when the government will purchase the credit rating of a bank and then be able to use the bank's credit rating when they issue their debt. Now, banks have very good credit ratings for obvious reasons. And so you purchase a great credit rating from a bank, substitute it for your credit rating, you get a good rate. The problem, though, is when you purchase these letters of credits from banks, banks oftentimes have unrealistic expectations with how much money they charge. So oftentimes they're cost prohibitive. They just cost way too much money for you to be able to purchase a credit rating of a bank. Sometimes what banks will do is, instead of charging a upfront amount of money, banks will add points onto the coupon rate. And so if you have a 4% coupon rate, the bank will say, we're going to add 3 points to that. And so it'll be a 7% rate. We're going to get paid that extra 3% back. Will come directly back to the bank to then recoup our losses from giving you our credit rating. Also, these letters of credit are temporary, and so they need to be renewed. And so if you're issuing a 30-year bond, you purchase a letter of credit from the bank. The letter of credit may only last for a year or 2 or 3 years. You then have to go back and negotiate a new letter of credit, whereby the bank can then raise their fees and raise their charges, and you're kind of stuck because you have to pay those increased charges because you've got this long-term debt. Otherwise, your coupon rates are going to go up through the roof. So sometimes letters of credit just aren't possible because they're just way too expensive and banks are too unrealistic. The more common thing that governments will do is they will purchase bond insurance. So just like we purchase insurance policies in our normal everyday lives, governments will purchase bond insurance. And so they'll get an insurance policy that will cover them in case they default on the debt. Obviously, these are expensive as well. We know insurance is expensive. You may never use that insurance, but it will help you get a better rate when you go out there and issue debt, because investors will feel more secure because they know they've got this insurance policy in their back pocket. And this is, if you're going to substitute credit ratings, this is usually the way you do it, is you do it through purchasing bond insurance to elevate your credit rating so that you can get a better deal when you issue your debt. What local governments would love to use is this third option known as state credit guarantees. A state credit guarantee, the state government will come in and say, we pledge to repay the debt if the local government is unable to do so. State of Ohio did this. State of New York did this, state of California did this, and they all got burned by their local governments because they came in and said, we'll repay the debt, and then there wasn't that much of an imperative for the local government to repay the debt, and so they then default on the debt. The state had to come in and bail them out. In the case of New York City, it got so bad that now the state of New York requires that New York City, if it's going to issue debt, it must go through a bond board. And they put together this bond board that must approve all debt that the city of New York is going to issue before New York can issue it. Again, to try and protect the state from having to repay obligations incurred by the city of New York. But again, the whole goal here is to try and get the lowest rates you can get, save yourself money. Typically, it gets done through the purchasing of bond insurance. Insurance is oftentimes done through a pooled process where you'll have several governments in the same area going together and pooling their resources to purchase pooled insurance policies that will then cover any defaults they have when they issue that debt. So you not only try and increase your credit rating in order to get a better deal, but you also try and get creative with some of the financing tools that you use. And this is why we don't always just rely on general obligation bonds anymore. Now we have a whole myriad of different financing options that we can use in order to try and save ourselves some money while still generating the money we need to pursue our capital projects. One of the most common creative financing options that has now become the norm is what's called the issuance of serial bonds. So bonds can be issued in two different ways. They could be term bonds or they can be serial bonds. A term bond is a bond where it all comes due at the same time. So you issue a term bond, the entire bond, all the issues in that bond will all come due maybe in 30 years, but everything comes due at once. In a serial bond, there will be different issues in that bond, and the issues will come due at different points in time. So you can stagger the maturity dates. So you can say maybe 20% of the issue 20% of the bond will come due within 5 years. Then another 20% will come due within 10 years, and another 20% in 15 years, and so on and so on. You do that because once you've paid off that first 20% after 5 years, then you free up that money that you were normally making principal and interest payments with, and you can then use that money for some other type of expenditure. Or you can use that money to accelerate the pay down on the rest of the debt. So today, the vast majority, if not all bonds, tend to be serial as opposed to term bonds. Now, most states will limit the number of maturity dates you can have in a serial bond. And the common way they'll do that is they'll say, you can issue serial bonds, but you can't have any more than 5 different maturity dates. And so they'll limit the different maturity dates you can have in your serial bonds. But the vast majority are what we call serial bonds. And we're going to jump ahead a little bit, but an interesting way in which bonds are issued is that we talk about them as being bonds. And say, oh, they've issued a bond. The truth of the matter is you don't really issue a $30 million bond. Bonds are broken up into what are called fives. Just like the number 5, they're called fives. And so they're basically broken up into $5,000 denominations. And so each issue will be a $5,000 denomination. So when we say bond, we're really talking about a bunch of $5,000 issues all cobbled together into what we refer to as a bond. So having all those different fives allows you to have those multiple maturity dates with a serial type of bond. Another creative approach that we've seen governments use, and it's used here in California, but it goes by a different name, what's called a zero coupon bond. In a zero coupon bond, governments will not make any interest payments over the life of the bond. So say you have a 20-year zero coupon bond. You'll only maintain principal payments throughout that 20-year period of time, but then at the end of that 20-year period of time, when it comes to maturity, you then have a big balloon payment for all the unpaid interest, and all the interest gets paid at maturity. Now, that could be beneficial to certain types of investors. If you're an investor and you want to save money for like a college fund or something like that, a zero coupon bond might work for you because you know you're going to get this balloon payment in 20 years, just in time for your kid to go to college, and you're not going to be spending your interest payments along the way every year. So for some investors, those work really well and they're very attractive. For governments, they're attractive because it lowers the annual debt service payment. As long as you're able to make that balloon payment at maturity, then you're going to be having smaller payments throughout the life of the bond. The problem is that balloon payment at maturity. Most governments don't plan ahead as well as they should, and so they get to that end of that 20-year maturity, they've got this big balloon payment. So what do? They refinance it, and they borrow more money to then pay off that balloon payment, and they've just incurred more debt moving on to the future, and it ends up being kind of a self-perpetuating type of process. Jay asked, do bonds have maturity dates? Yeah, the vast majority of bonds are going to have a maturity date where they have a certain period of time before they have to get paid off. Some maturity dates are very long. I mean, there are not a lot of bonds that are in perpetuity, but some are very long. Some can be 30, some can be 40, some can be 50 years in length. They can be very long types of maturity dates. Sometimes they can be refunded, what we call refunded along the way. And so you might have refunding periods. And so you might have a refunding period every 10 years. And if you have a refunding period every 10 years, then every 10 years you can call that debt in, you can refinance it, and then it moves forward. So sometimes you'll see that. So the original bond hangs around for a long time, but every 10 years, the terms of that bond will change every time that bond gets refunded. So sometimes it works that way as well. But for most municipalities, you're going to have, usually it's going to be a 25, 30, 35, 40-year type of bond. That's pretty typical for most local governments. So these zero coupon bonds can give some flexibility to governments. The problem with the zero coupon bonds is, again, when you don't have the money to make that balloon payment. Here in California, there's a type of zero coupon bond that's known as a CAB, a C-A-B. It's a capital appreciation bond. CABs, capital appreciation bonds, the state legislature has tried very hard to get rid of them because they were a really bad slippery slope for a lot of governments, especially local education agencies. And so now local education agencies aren't allowed to use capital appreciation bonds very much anymore. There are some that are grandfathered in, but for the most part, you're not going to be able to use them because so many school districts got in trouble not being able to make that balloon payment at the end of maturity. But again, they're capital appreciation bonds, what we call it here in California. It's essentially a zero coupon bond, and you still see those used in a lot of states across the country. Another creative financing option are what are called call and put provisions. So a call provision is a provision that will be written into the design of the bond that will allow the government to call the issue in and refinance it if interest rates go down. So if you see interest rates going down, you're going to be able to save yourself some money. You then call the issue in, you refinance it, or what we call in bonding, refund it. And then when you refinance, refund it, you can then refund at a lower interest rate and then save the taxpayers a lot of money. A couple of years ago, I served as a president of a JPA, Joint Power Authority, and we refunded a bond measure. We brought a bond measure in, we used the call provision, brought it in, we refinanced it because at that point, interest rates were so low that they were near zero for municipal debt. So we were able to refund it, and we ended up saving something like $850,000 that we were able to save taxpayers by refinancing that debt. we not only were able to save that money, but we were able to then shorten. So we not only got lower interest rates, we were able to shorten the maturity date of the debt and get it paid off in half the time it normally would have been paid off under the original construction of the debt. So if you've got a really attractive issue that you think investors are going to be falling all over themselves to try and purchase, you put these call provisions in to kind of give yourself the ability, if financial situation warrants and interest rates go down, you can save yourself a lot of money. The opposite of the call provision is a put provision. So if you've got an issue that's very difficult to sell and investors are really being very hesitant on purchasing that issue, then you might want to put in a put provision to make it a little bit more attractive. Put provisions allow investors to bring the issue in and refinance it if interest rates go up. So you're exposing yourself here. So if you had a put provision, and with the way interest rates are going now, you probably end up losing a lot of money because investors are going to be calling that issue in and refinancing that issue. But it's a way that you can make it a little bit more attractive to investors and sell what would otherwise be a very unattractive type of bond. So again, we get really creative with a lot of these bonds. So there are lease revenue bonds, there are lease rental bonds, there are what are called lease sale back bonds. There are all kinds of permutations of different types of bonds. Sometimes what we will do is we will use a lease revenue bond, and so we'll lease out the project and then we'll repay the debt through the revenue that's generated from the lease payments. Sometimes there are what are called leaseback bonds. We do those oftentimes in funding schools, where the developer actually will own the property, own the school, and then the school district will lease that back from that developer, and then the developer actually pays for it, and then you will repay the developer through those lease payments. And there's all kinds of different, like I said, permutations of different types of bonds you see used here in California. The lease revenue bond is a pretty common one. We see that used a whole lot, especially in the world of education finance. But those are all long-term. Bonds are long-term measures and maturity dates of more than 1 year. And then we also have short-term issues. And short-term issues are less than a year in maturity. And we usually refer to those as being notes. So bonds are long-term issues. Notes are short-term issues. Jay asked, do public-private ventures change the finance structure? Yes, they do. That's a very good question. That once you have a public-private venture, you have a private component to it, which then makes it more difficult to get it to fall within the federal tax exemption. And then you're probably dealing with private activity debt, and again, struggling to try and get that included within your state cap to make sure that you can still keep it tax exempt, even though there is that private component to it. So yeah, once you have those public-private ventures, once you have the private sector involved, that's when it gets a little dicier in terms of tax exempt status. So again, these notes are usually less than 1 year in maturity, and there are a lot of different types of notes. They're rated differently than bonds are rated. We'll get to bond ratings in just a second, but some of the different types of short-term issues, short-term notes you'll see are things such as, and these all rhyme, TANs, RANs, BANs, and GANs. A TAN is a tax anticipation note. And so if you know you're going to get tax revenue coming in the very near future, but you need some revenue to tide yourself over, you issue a tax anticipation note, and then the tax anticipation note will be secured by the value of the tax revenue that will be coming in a future period of time. Revenue anticipation notes are just for revenue, and so if you have general revenue coming in that's not just tax revenue, but it's general revenue, you can use a revenue anticipation note. And the state of California, back when fiscal times were not as good as they are now for the state budget, used a lot of these RANs to kind of tide themselves over from the end of one fiscal year into the beginning of another fiscal year. BANs are bond anticipation notes. Now, when you issue a bond, it's a long process, and it's going to take you a while to get those bond proceeds. So you may have designed your bond, you may have had your bond approved, you may have an underwriter who has found investors for that bond, but you're not going to get the proceeds from those investors right away. It takes a while for all that money to roll in. If you want to get started on a project very quickly, you can issue a bond anticipation note, securing that bond anticipation note with the bond proceeds that will be coming in sometime in the future. GANs, or grant anticipation notes, work the same way except with intergovernmental grants and aid. TECP stands for tax exempt commercial paper. Tax exempt commercial paper. These are very short-term types of borrowing mechanisms. They usually mature between 15 and 45 days. Again, if you need a really quick influx of revenue, you can do a TECP, tax exempt commercial paper. Still is tax exempt, but it turns around very quickly, and then you have to have a way to pay it off within that 15 to 45 days. So again, it's a really quick influx of cash for whatever you need it for. And then another really short-term borrowing mechanism is what's called a VRDO. It stands for a variable rate demand obligation. A variable rate demand obligation. These can be really nasty. And they can be nasty because the rates on these are variable and they can change very quickly. And they're called variable rate demand obligations because the rates can change at the demand of the investors. And so if you're in a situation like you are now, where you just saw the Fed increase their premium rate by 3/4 of a point, that's going to drive up rates on VRDOs as well. And so your investors could say very quickly, we want to take advantage of that, and they take advantage of it, and then your borrowing costs go through the roof. They can be really dicey because those rates really do vary on a very frequently adjusted basis. Some of those that can adjust as frequently as weekly, we call those low floaters, and low floaters will adjust on a weekly basis, again, leaving you really susceptible to market changes very, very quickly. But those short-term issues, again, are usually for a quick influx of cash that will be paid off in relatively quick order, no more than 1 year in duration. So how do we go about issuing debt? How does this entire process work? It is a long, protracted process. It's not as simple as the government saying, we need money, let's issue debt. You've got a long process you go through, especially if you're issuing general obligation debt. So your first step in the process is deciding whether to issue the debt and if you have the legal ability to issue that debt. So this is where you have to determine your general obligation debt capacity. We talked about this a little bit earlier on. Every state will have a state-imposed debt margin, whereby it will stipulate the percentage of assessed valuation of property that up to the amount that you can issue debt. So you take your assessed valuation of property, which is your tax capacity, multiply it times the percentage of debt allowed, which is usually 3%, and that will then give you what we call your debt margin, which is the amount of overall general obligation debt that you are able to issue based upon your tax capacity. So the higher your assessed valuation of property, the more tax capacity you have, the more general obligation debt you'll be able to issue. Once you know what your general obligation debt margin is, and that's the dollar figure of general obligation debt you can issue, you then subtract from that any outstanding general obligation debt principal, any general obligation debt that you currently owe, plus whatever you are proposing to issue, to make sure that you still have enough capacity to go out there and issue that debt. In my school district, when we issued the general obligation debt in 2014, we had to do that. We had to calculate our general obligation debt capacity, and we were, and by percentages, we were less than 50% of what our capacity was. And so we had, I think it was like $220 million of debt capacity left, and we issued 148 out of that 220 million, just to make sure we still had additional capacity remaining in the off chance we needed it, which is important because now that district and a lot of other districts, they have to go through and they have to retrofit all their schools for earthquake readiness. And a lot of districts have not done that, and so they need that additional general obligation debt capacity. So you determine whether or not you have the legal ability to issue that debt. Do you have enough capacity left to issue the debt? Then you have to go into the issuance phase. In the issuance phase, you have to have a legislative hearing, a public hearing, where you decide to issue the debt and have a public vote on issuing the debt. And then if it's general obligation debt, you're probably going to have to go out there and get voter approval. And again, it's usually a 2/3 voter approval unless a Prop 39. If it's a Prop 39 general obligation type of issue, then you only need 55%, but you still need to create that citizen oversight committee in order to make sure that you are spending the money properly and in accordance with how you're supposed to spend the money. If you do need to go out there and get voter approval, you have to design ballot language whereby you specifically say all the projects that you are going to be funding with this general obligation debt. So you have to be very specific about what projects you're funding, how much those projects are going to cost, and then you are limited to your ballot language. So if you do not put a project in your ballot language, and then later on down the road, you want to spend some of this general obligation debt money on another project, you are precluded from doing that. You can only spend it on what you've included in your ballot language. And so it's very important for you to get a bond counsel. And so every government will hire a bond counsel. For governments to do a lot of borrowing, they'll have bond counsels on retainer, and that bond counsel will then clean the issue for you. They will make sure that you have the legal authority to issue it. They will make sure that your ballot language includes all the different projects that you want to include in that bond. We'll make sure that the election is scheduled appropriately with the county recorder's office, the county clerk's office, and make sure everything is done in a legal manner. That's what we call a clean issue. So once you have jumped over all those legal hurdles, you then have a clean bond issue. You're then ready to go to the voters and get that bond issue approved. Once that bond issue has been approved, you also then need to contract with a financial advisor. And that financial advisor will help you design the specific features of that bond. Things such as if it's a serial or a term bond, and chances are it's going to be a serial bond. The number of fives in that serial bond, the repayment period, the maturity date for those bonds, whether there'll be call provisions or put provisions in those bonds, what types of covenants need to be designed within those bonds. All those things your financial advisor will help you determine in actually crafting the bond issue itself. You then sell the bond to an underwriter, and the underwriter will then take the bond out into the market and will then find investors to purchase that bond. Now, for your financial advisor, if you are dealing with something other than a general obligation bond, especially if you're dealing with something like a revenue bond, your financial advisor will help you come up with what are called bond security agreements, provisions within that bond language to ensure investors that they are going to get their money back. Because again, it's not a very secure type of investment, but if you can design it with features that will guarantee to your investor that they will get their money back, then people are going to be much more likely to invest in that debt. So some of the common types of agreements you have in revenue bonds are things like flow of funds requirements, where you'll be required to keep the money to repay the revenue bond separate from all other type of debt. And so we had said before, when we talked about accounting last week, we talked about fund-based accounting, we talked about debt service funds. Sometimes your bond security agreement, if you have a revenue bond, will require that you create a separate fund, separate from your normal debt service fund, to put the money in to repay the revenue bond. Again, to ensure investors you're not going to double spend their money. You need to show that you're going to have adequate amount of money to meet your operating expenditures, because if this is a rec center and you don't have enough money to operate it every year, you're not going to have the revenue coming in to repay the debt. Usually there'll be percentages of set-asides that you'll have to have. Typically, you have to set aside at least 1/6 of interest payments and 1/12 of principal payments to then make sure you have enough for upcoming payments. Sometimes they'll just require that you set aside 1 year of principal and interest payments, set that aside to cover any possible deficiencies. They'll also probably want you to have some covenants in your revenue bonds as well. So a rate covenant that you're charging a high enough rate to get enough revenue to repay the debt. operational covenants, which you'll guarantee how the rec center is being run, the people who will be running that rec center, their qualifications for the staffing, insurance covenants, what type of insurance are you going to keep in terms of fire and liability insurance, default covenants, what happens if we default on the debt? How does the investor then get their money back? Are there any provisions in terms of maybe having bond insurance or something like that? An audit covenant. What types of audits need to be conducted? How often do those audits need to be done? Are they only financial audits, or do you have to do performance audits? Who does the auditing? Is it internal auditing or outside, external auditing? Again, you're giving all these guarantees to your investor because the revenue bond is going to be much less secure than what they would normally get with a general obligation bond. Then you have to go out there and get a bond rating. So once you've got your bond designed and you had it approved by your voters, then you have to get a bond rating. And this bond rating will tell you how much you're going to have to repay in terms of interest coupon rates. So there are three main bond rating companies. There's Standard & Poor's, there's Moody's, and the third one is called Fitch's. The two big ones are Standard & Poor's and Moody's. My district usually uses Moody's. They use Standard & Poor's once in the past, but they usually utilize Moody's as their bond rating company. You're only going to select one and use one because getting a bond rating is a very expensive proposition. So you select the bond rating company and you then fill out the application. You apply for your bond rating. They will then assign an analyst to your case. The analyst will then require you to submit documentation. We'll talk in a second about what you're documenting, some of the things they're going to look at. They will research all of your financial indicators. They will do a fiscal solvency analysis of your government. They will then put it all together in an analysis and make a recommendation to the rating committee. Sometimes you will actually go in person and you'll appear before the rating committee and kind of argue your case and defend if you have any weaknesses in your file, defend what those weaknesses are and why you have those weaknesses, and actually kind of defend your life in front of this ratings committee. And then the ratings committee will then make an assignment. The whole appearing in person with the rating committee is something that's relatively recent. It used to be all done through paper. Now it's relatively recent development. And in our last bond issue in my district, I wasn't president at the time, thank goodness, but the board president, the superintendent, and the assistant superintendent of business all went up to San Francisco to the Moody's headquarters and sat down with them and actually met with the rating committee before they got their bond rating. So the rating companies will give you a rating for your bond. And again, this is what is unlike a credit rating. We always think about our individual credit ratings, but you have different credit ratings. You have a consumer credit rating, you have a mortgage credit rating, you have an automobile credit rating, you have a credit card credit rating. Well, the same way here, you have different bond ratings. And so every time you go up with a new bond issue, you have to get a new rating for that bond. So sometimes we talk about the city has a AAA bond rating. Well, it really doesn't. The bond that it put forth has a AAA rating. The next bond it puts forth, if its fiscal conditions worsen, may not be a AAA, maybe an AA1 or an AA2 or AA3. But typically what you're hoping for is you're looking for a bond rating that is certainly in the A category, and hopefully it's in the AAA or the AA category. Now, most local governments are not at the AAA category. The majority of local governments are in the AA category, either AA2, AA1, or for Standard & Poor's, AA plus or AA. And if you're anything above a AA rating, you're going to get a good coupon rate. And so it's going to be very attractive to investors. Once you get down to the A level and below, if you get into like triple B and double B, that's when you're going to be able to be paying a much higher coupon rate to sell that debt. If you get down into the C level, that's considered to be a speculative investment. And you're going to have a very, very difficult time issuing debt if you're down at that C rating. And that's where New York City and City of Cleveland found itself in the 1970s. So how are these ratings determined? They're going to look at a lot of different indicators of your city's finances. And some of these things we are very familiar with when we talk about fiscal solvency. So as things such as debt. How are you using the debt? Is the debt being used for a good purpose, like constructing a city hall or buying a new fleet of police vehicles? Or is it being used to offset imbalance between revenues and expenditures, to offset a deficit? So how is it being used? How do you plan to retire the debt? What's your current debt burden? So we're going to compare like you did with fiscal solvency. We're going to look at your debt burden per person, per capita. We're going to look at your debt burden as a percentage of your general fund balance or as a percentage of your assessed valuation. So how much debt do you currently have? What's your debt history and trends in incurring debts? And for this, they're going to go directly to the statistical section of the CAFR, because that's where you're going to find all your debt history, usually over a 10-year period of time. What's the current status of your physical plan, your capital plan? Because if you are borrowing money for a new city hall, but you're also going to have to reconstruct your sewer system, and you're going to have to upgrade your water system, or whatever the case may be, you've got a lot of additional projects coming in the future. That's going to hurt your bond rating for this issue that you're trying to issue today. Promptness of bill paying, just like in our private lives, how promptly do you pay your bills? What's your tax capacity in terms of your tax base, your trends in your assessed valuation of property? What are your collection rates? And this is a big one, that for both Standard & Poor's and Moody's, cities are expected to collect at least 97% of their property tax levy. And if they're not collecting 97% of the property tax owed to them, that's going to be a red flag for the credit rating agencies. How diverse is your revenue portfolio? Are you solely reliant on property tax revenue, or do you have things like transient occupancy taxes, hotel taxes? And you're also then relying upon maybe user fees and user charges, service charges. The more diversified you are in your revenue portfolio, obviously the more stable you will be as a government. Your percentage of debt service compared to your total expenditures, one of those fiscal solvency indicators that you did last week. The accuracy of your estimates, how close are you in your estimates to what actually happened? Level of professionalization in your city, your level of service provision. This is why a lot of cities spend a lot of time doing citizen satisfaction surveys to see how satisfied citizens are with not just the level of service provision, but the quality of service provision as well. Your intergovernmental aid. The more reliant you are on intergovernmental sources of revenue, the more unstable you are going to be. They want to see, credit rating agencies want to see you be mostly reliant upon own source revenue that you have direct control over. What's your land use? What are your land use policies like? Are you a 99% developed city? If so, then the only way you're going to be increasing your property tax base is through redevelopment, which can sometimes be kind of difficult to do. Or are you only 40% developed? You have 60% of the land that has yet to be developed, because new development is a lot quicker and a lot easier to do oftentimes than trying to redevelop existing properties. And so if you've got a lot of room for growth in terms of your assessed value base because you have a lot of undeveloped land, that's going to be a positive sign. What are your population trends? Are you losing population? Are you gaining population? What are your trends in terms of wealth? Again, are you increasing your base? Are you losing your base? Is your base remaining steady? Your commercial industrial base. Do you have corporations moving in? Do you have corporations moving out? And so again, just some of the factors that Standard & Poor's and Moody's will take into account when they give you your bond rating. The better the bond rating, the lower your coupon rate, and the more money you will save as a government. Once you have your bond rating, then that's a signal to investors about how attractive your bond issue will be. And you then have an underwriter that then takes it to market and will then sell that security. Question then becomes, what underwriter do you use? Well, there's a competitive bidding process and a negotiated bidding process. Competitive bidding process, you will advertise and you will invite underwriters to bid to purchase a security that they will then go out there and they will sell in the market. Negotiate it, you select an underwriter, and you then negotiate with that selected underwriter. Most governments today will do a negotiated selling of their securities, where they have an underwriter they've worked with before, they're comfortable with that underwriter, they go back to that underwriter, they negotiate with that underwriter, and that underwriter then takes the issue to market. there is, and the number escapes me right now in my old age, but there is a statutory limitation on the fees that underwriters can charge when they are negotiating with governments. But underwriters, if you're issuing a $10 million issue, your underwriter fees probably be close to about $250,000 for that $10 million issue, or it could be even more. Being an underwriter is a good business to be in. It can be a very lucrative business. But that underwriter will then take the issue, will take the issue out in the market, will sell the issue, and then the proceeds come into the government, and the government then has the proceeds to then pursue the construction of that capital project. And that's how debt issuance works in a general nutshell. Again, it's a very complicated process. It's something that we could devote an entire course to talking about issuing debt. Unfortunately, tonight we had about an hour and 20 minutes to spend on it. And so it's just kind of the tip of the iceberg, the highlights. But that's how governments go about issuing debt. That's why it's so important for governments to try and maintain a good bond rating so they can save themselves money so that they can issue debt to build these needed types of capital projects and facilities. I know it's 7:20. I've been talking for quite a while now, so we're right about our normal break time. So why don't we take a break now? We'll take about a 15-minute break, come back at 7:35. When we come back at 7:35, we'll wrap up this discussion of debt, and then we'll move into a discussion of revenue and talk primarily tonight about tax revenue, different sources of tax revenue, and their advantages and their disadvantages. So let's take a break until 7:25. Come on back, and we'll talk everyone's favorite topic, which is taxation. Okay, it's 7:35, so we are back. And again, I know it's kind of unusual in my classes for me to talk so much, but this is a 6-week class. We have so much information to cover, and I want to make sure that we get through everything. Since this is a core course, and you will, when you get to 697, be doing a budgeting case study, I want to make sure that we cover all the information we need to cover so that you'll be well prepared then once you get out of the class and go into 697 and beyond. So that's why I'm doing a lot of talking, just to make sure we get through all the information. But before our break, we talked about debt, and so what I would really want your takeaway to be from that discussion is that you have just kind of working familiarity of why we issue debt, working familiarity of some of the major types of long-term debt bonds and their advantages and their disadvantages. A lot of the minute details you might not ever use again, but I think it's important that we know what we do with debt, types of debt we use, and some of the advantages and disadvantages of different types of debt. And if we've done that, then I think we've accomplished our goal for debt management. But obviously, if we're going to function as a government, we need to bring in revenue. And we're all painfully aware of the fact that a lot of the revenue comes from taxation. And we as taxpayers are contributing to that revenue. So what I'd like to talk about for a little bit of time tonight is to talk about different tax sources of revenue, talk about where our tax revenue comes from and how different types of tax revenue work, the big three: property, income, and consumption-based taxes, and talk about some of their advantages and their disadvantages. I think what we'll do tonight is we'll focus primarily on taxation, and then we'll hold off on our discussion of non-tax sources, and we'll hold that off until next week. And then our last session next week, we'll do non-tax sources of revenue, and then we'll wrap up the show with a discussion of intergovernmental sources of revenue and a final course conclusion. I think that probably would work out pretty well. So let's just spend our remaining time tonight looking at taxation. So our big three sources of taxation, we look at property taxes, income taxes, and sales or consumption-based taxes. In comparing these different types of taxes, Mike Sell provides us with some evaluative criteria that we can use. So a basis on which we can compare these different tax sources. The first evaluative criteria that we can use is burden distribution. We ask the question of who should pay the tax. So should tax burden be apportioned based upon someone's ability to pay? So people who have a higher ability to pay more in taxation than people with less of an ability to pay? Or should we apportion the burden distribution based upon the benefits that someone receives? So if you receive a benefit from engaging in a certain type of behavior or consuming a certain type of product, then you should pay based upon the benefit that you've received from that behavior or that activity. Some of our taxes are ability to pay taxes, such as property taxes and income-based taxes. Some taxes, like consumption-based taxes, are based upon that benefits received principle. Second consideration we have is equity and fairness. So how fair is that tax structure? We usually evaluate tax structures on the spectrum of regressivity and progressivity. How regressive is the tax versus how progressive the tax is. A progressive tax structure will charge a higher percentage in taxation to people with more of an ability to pay. A regressive tax structure will penalize people at the lower income level, and they will pay more at the lower income level, or a higher percentage at the lower income level, than their colleagues at the higher income level will pay. We usually try and design our tax systems to be as progressive as we can make them. Some taxes tend to be naturally more progressive than others. The graduated income tax tends to be designed to be more progressive in nature. The property tax, by contrast, tends to be highly regressive. Because of the property tax, you are charging people their ability to pay based upon the value of their property. Well, there can be a big disconnect between the value of someone's property and their annual income level. So they're going to pay their property taxes out of the money they're earning. They're probably not going to refinance or sell their homes to pay the property tax. So if you have a very low value home, a very high value home, for someone who's not making a lot of money, that's going to be a regressive type of tax, because they're going to have a very big property tax bill, but not much of an ability to pay that bill. So how equitable, how fair the tax is it more progressive or is it more regressive in nature? Third criteria is adequacy. How adequate is the revenue that's being generated from this tax? Most of our tax sources generate very adequate revenue. You think about the federal income tax. Federal government relies almost exclusively on the federal income tax because it's a very adequate type of tax. Local governments rely very heavily on the property tax because, again, it generates a very adequate yield. Next consideration is collectability. How collectible is the tax? Some taxes are naturally collectible. Some taxes are much more difficult to collect. So when you think about collectability, think about it in terms of how taxpayer active versus how taxpayer passive the remittance of the tax is. So how much of an active role does the taxpayer have to take in remitting tax payments? If it's a very taxpayer active type of tax, typically it tends to be less collectible. If it's very taxpayer passive, it tends to be more collectible. So when you think about your check that you receive from your employer, taxes are automatically withheld from that check. That withholding process makes it relatively taxpayer passive. So it's very collectible. It's automatically withheld from your weekly or monthly check. If you want to change the amount of money that's being withheld in taxes, you have to go and change your W-4 form, and you have to change your withholdings form. So for the most part, it's very taxpayer passive. You think about something like the sales tax. Sales taxes are rolled into the price of the good that you're purchasing. And so it tends to be a very taxpayer passive type of tax. It's also taxpayer passive because it's collected by the vendor. It's collected by the shop owner and then remitted to the state by the shop owner. Well, there are fewer vendors than there are taxpayers. And so it's a much more orderly process, much easier to collect. So the more taxpayer active it is, the harder it is to collect. More taxpayer passive, the easier it is to collect. Then your final evaluative criteria is economic effect. And this is a two-way street. How does the tax affect the economy? How does the economy affect the tax? So if you increase tax rates, what's that going to mean for economic activity? How elastic is demand for that certain type of product? Because anytime you increase the tax on a product, you're having a price effect. You're increasing the price. If the price goes up and demand goes down, it's a very elastic type of demand. You're going to have negative impacts upon economic activity. If it's not very elastic, if it's very inelastic in nature, that even if you increase the tax, the price goes up, people will still purchase it. It's not going to have a big impact upon economic activity. Then the second way of that street is, how does the economy affect tax revenue? How insulated is the tax from economic fluctuations? So something like the sales tax is usually not very well insulated from economic fluctuations. As the economy goes down, people are out of work, they have less disposable income to spend, so therefore they're going to purchase less, which means sales tax revenue is going to go down. A tax that is more insulated from the economy tends to be sometimes something like the property tax. So people are still going to buy homes, people are still going to own homes. There is a possibility that when you have a bottoming out of the housing market, like we saw about 14 or 15 years ago, that property tax revenues will go down, and that did happen. But for the most part, when you look at trend lines of property tax revenue, it's usually on the incline, that you tend to see property tax revenue increase year upon year over time. So burden distribution, equity, adequacy, collectability, and economic effects or economic efficiency are your major evaluative criteria that you'll use in evaluating what type of tax you want to utilize or what type of tax you want to increase. Now we're going to talk about the three major types of taxes: property, income, and sales taxes. When we're done with each type of tax, we'll go back to those evaluative criteria and we'll evaluate the tax on those evaluative criteria. So let's start with the property tax. Most of us focus primarily on the local level of government. We work in local government. So we know the property tax is a primary source of revenue for a lot of local governments. However, it is no longer the main source of revenue for a lot of local governments in California. And every year there's a report that's published that looks at the average percentage of tax by source for California cities. If you looked at that report back in the 1970s, you would see that the majority of cities get a majority of the revenue from the property tax. That's not the case today. Now, your city may get a majority of its revenue from the property tax because cities in Southern California tend to rely more on the property tax than cities in other areas of California. But there are a lot of cities that the property tax is no longer their number one source of revenue. Their number one source of revenue has now become user fees and user charges. And again, much of that is the result of our good friend Proposition 13 that was passed by the voters in 1978. And we'll talk about Prop 13 in a couple of slides. But even though it's not the primary source of revenue for a lot of local governments in California, it still is an important source of revenue for many. The property tax tends to be regressive when we get into a discussion of equity and fairness, and for the reasons I talked about before. Now, in calculating the property tax, there are two main components of the property tax. There is the property tax rate, and there is the assessment rate. The property tax rate is going to be the percentage of taxation applied to the assessed value of property. So you might have a 1% rate, or with some local add-ons, a 1.25% rate. The assessment rate is the rate at which the assessed valuation of property can increase from one year to the next. And as we'll see in Proposition 13, we have both a tax rate limit of 1% and an assessment rate limit of 2%. It's important that you combine the rate limit with the assessment limit, because if you only have a tax rate limit, so you're going to say we're just going to have a limitation of a property tax of 1% applied to the assessed value of property, you can still generate more property tax revenue by just increasing the assessed value of property in your jurisdiction. So a tax rate limit without an assessment rate limit it's considered non-restrictive because you can always change the assessed valuation to generate more revenue. Likewise, an assessment limitation without a rate limitation is also non-restrictive because you can say we're going to increase the enhancement in the value of property. We're going to limit that increase to 2% per year. So it can only go up by 2% per year. But you don't have a tax rate limit, then you can just raise more revenue by just increasing the tax rate from 1 to 1.5 to 2%, and so on and so on. So it's when you combine the tax rate limit with the assessment rate limit that you end up getting something that is truly restrictive in terms of restricting the amount of property tax revenue a local government can generate. That's what we have with Proposition 13. Proposition 13 is known as a property tax levy limitation because it's a combination of a 1% tax rate limit and a 2% assessment rate limit. When you combine those two things together, you get a property tax levy limit. That's what we have with Proposition 13. Oops. So if you want to keep increasing the amount of property tax revenue you're generating as a local government, you can just change the assessed valuation of your property if you don't have an assessment limit in place like we have here in California. Governments will reassess the value of the property sometimes on an annual basis. Sometimes they'll do it every other year. Some states will do it every 5 years or every 7 years. But the assessed value of the property will be the base on which you calculate the property tax liability for that property owner. Typically, the most common basis for assessed valuation is what's known as the market value. The market value is what this house should sell for if it was on the open market. So if this house was for sale, this is what the house should sell for. That's what's called the market value. Here in California, we use an approach known as the welcome stranger approach. And it's a pejorative term. Welcome stranger, here's your new tax bill. And the way it works with Proposition 13 under a welcome stranger approach is the property is reassessed for taxation purposes when that property changes hands. So if you bought your house for $100,000 years ago, you were subject to a 2% increase each year of your assessed valuation, but it would not be reassessed then until you went and sold it. So if you then sold it 30 years later for $800,000, then that $800,000 would become the new valuation for that house for the purposes of taxation. The nice thing about the welcome stranger approach is it protects current homeowners from quickly appreciating property values and from getting these exponential increases in their property tax bills as the value of their property increases over time. The downside, though, is that it violates a principle of equity, and a principle of equity known as horizontal equity. Horizontal equity says that two similarly situated taxpayers should pay similar tax bills, should have similar tax liabilities. So if you have two identical homes that are located next door to each other, those two homes have the exact same amenities. So they have the exact same square footage, they were built in the same year, same number of bedrooms, same number of garages, all the exact same amenities in the exact same condition. Those two houses should have the same assessed valuation for the purposes of taxation. Under a market value approach, they would. Under a welcome stranger approach, they probably do not. If the person in the house on the left purchased their house in 1975, the person in the house on the right purchased their house in 2015, the person on the left purchased their house for $100,000, person on the right purchased it in 2015, their house for $800,000. The person on the right is going to have a much higher tax liability than the person on the left because their assessed value is going to be 8 times as high as the person on the left, or something in that range. So the welcome stranger approach violates this idea of horizontal equity. It has been challenged here in California. The California State Supreme Court has allowed it to stand because they've acknowledged that there is this violation of horizontal equity, but they said the most important thing is that homeowners are being protected from increases in their assessed valuation through no fault of their own. And it also provides a very stable source of revenue for local governments. Local governments know what they're going to get out of their property tax revenue. So we've got that welcome stranger approach again as part of Proposition 13. But that is unusual across the country. Most states use a market value approach. What would this house sell for? What should it sell for if it was actually for sale today? Another approach to coming up the assessed valuation is what's called an income approach. This is going to work if you have, for instance, an apartment building, something that generates income. You base the assessed valuation on the amount of income that's generated by that property. Then there's a costing approach. The costing approach to assessed valuation will ask the question, what if we had to replace this structure? So if we had to, the structure was gone, we had to replace it exactly how it currently sits, how much in today's construction dollars would it cost to completely replace this structure? That's a costing type of approach. And there are a couple nuances, we won't get into them, but how much would it cost to replace this structure? Now here in California, we have the welcome stranger approach. And so we are going to tax at 100% of the assessed value, the value of that home when that home changed hands. A lot of states will use what they call a fractional assessment. So in some states, they use a market value approach. They will assign a fraction to the value of that house to come up with the assessed valuation. So if the market value of the home is $100,000 and they use a 30% fractional assessment rate, then the value of that home for tax purposes would only be $30,000. 100,000 times 30%. Your assessed valuation for tax purposes would be $30,000. You're only paying tax on $30,000 valuation instead of the $100,000 market value. That's a fractional assessment. Here in California, we have a 100% fractional assessment for single-family homes. Fractional assessments oftentimes used as well for different types of property, that you'll have different fractions applied to different categories of property. So you'll have one fraction that's applied to a single family home and a different fraction that's applied to agricultural property. So typically we'll have a lower fractional assessment for agricultural property because that's property that's used in the generation of a business. And so they get a lower fractional percentage than what you would get if it's your primary source of residence. Our goal, again, is that we will have similar properties with similar assessed valuations. And again, we violate that routinely here in California with Prop 13. The statistic that's usually used to calculate it is what's called the coefficient of dispersion, where again, you're using it to try and determine are two similar properties getting similar tax liabilities. And here in California, that simply does not happen because of Prop 13. Prop 13 is the primary property tax reduction that we have here in California. It's what's referred to as a circuit breaker. And so regardless of the type of tax you are using, governments can utilize what they call circuit breakers to reduce the tax liability for certain taxpayers. Proposition 13 is a circuit breaker to reduce the tax liability for homeowners. We'll see when we talk about the income tax, things such as deductions and credits are circuit breakers to try and reduce the amount of liability for income taxpayers. Commodity exemptions are circuit breakers that we use in sales taxes to try and exempt certain types of commodities from sales taxes. But for property taxes, Prop 13 is a good example of a circuit breaker. Exemptions. We have things like homestead exemptions that we will use to, again, try and lower the tax liability for homeowners. There is a $7,500 homestead exemption that you can get here in California that will exempt the first $7,500 of the assessed value of your home, that you don't have to pay taxes on that first $7,500 value. There are circuit breakers, exemptions for senior citizens, for people who have disabilities, lots of different types of circuit breakers that we use to reduce tax bills. Negotiated circuit breakers are what are known as tax abatements. And so this is where you have governments that enter into negotiations with corporations to lower their tax bill as an inducement to get those corporations to move within the jurisdiction. So you might say, we're going to give you a property tax abatement for 5 years, where we're going to reduce your property tax bill 50% for 5 years if you move into our jurisdiction. But let's look primarily at Prop 13, because that's the big circuit breaker here in California that everyone knows and is very familiar with. Proposition 13 was passed by the voters in 1978 as a constitutional amendment. It was led by the Howard Jarvis Taxpayers Association. And again, the purpose of Proposition 13 was to shield homeowners from quickly appreciating assessed valuations, in that people were moving to California and property values were going up through the roof. So as someone's property value went up, their tax bill went up as well. So we wanted to shield homeowners from being taxed out of their homes. So you get this Proposition 13. 1% property tax rate limit coupled with a 2% assessment rate limit, so that the assessed valuation of a property may not increase by more than 2% year over year. Now there's a caveat there. Caveat there is, say for instance, you're going to do a major home renovation and you go and you pull permits to put in a new pool that's going to increase the value of your home by $50,000. That's an exemption. So that's exempted from this 2% limit. So you'll see the assessed value of your home go up after you pull that permit for that pool once that pool is constructed, because you've done these proactive things to increase the value of your home. But for the most part, unless you do something like that, it can only increase by 2% year after year. So again, you combine that 1% tax rate limit with the 2% assessment rate limit, it creates a property tax levy limit and limits the overall amount of property tax revenue that the local government can generate. That's what Proposition 13 is. Now, if you're a homeowner, you may look at your property tax bill and say, wait a second, I'm paying 1.25%. I thought it was a 1% limit. There are local add-ons that are allowed to go above that 1%. So you may be living in a school district that has issued a bond, and that bond adds on to your tax payment. You may live in a Melrose area, in a community facilities district, the CFD. And if you're paying Melrose taxes, that's going to greatly increase your tax bill, because that's above and beyond your normal tax rate. And so you may be paying 2%, 2.5%, 2.75% if you have those additional Melrose taxes. Melrose taxes are named after the two members of the legislature that came up with the legislation, one in the Assembly, one in the Senate. I believe Mello was in the Assembly, I believe Ruse was in the Senate. Came up with this idea of Melrose, so that if you are in a community facilities district, you're going to say, for instance, a development that was developed over the past couple of decades, you pay Melrose taxes to fund maybe the new school in the area that will support the kids coming out of that new development. Maybe you're paying for a fire station that will support those houses in that development. That's what's paid for with those Melrose taxes. Melrose taxes, how long they last will depend upon the mitigation agreement with the government, the developer. Some Melrose taxes are 20 years, some are 30 years, some are 40 years, some are basically in perpetuity. And so you have to look at your mitigation agreement to see how long your Melrose taxes go. But that will greatly increase your tax rate above and beyond the Prop 13 1% level. We had some propositions along the way to expand Proposition 13. In 1986, we had Proposition 58. Proposition 58 allowed parents to pass their houses on to their children, and the children keep the assessed value of that property. Proposition 193 allowed grandparents to pass houses on to their grandchildren and keep that assessed value. Then in 2021, we had Proposition 19. Proposition 19 was a limitation on Prop 13, whereby Now we say in order for that assessed value to pass on from parent to child, the house must remain that child's primary residence, so they can't keep it as a rental home. It needs to be their primary residence and be an assessed valuation under $1 million. So we're limiting who can partake in the benefits of Proposition 13. But again, the major benefit is you get to keep that assessed valuation as the child getting the house from the parent. Another change we got from Proposition 19 is for older Californians, if you are 55 years or older, or if you are disabled, or if you've been affected by a disaster, you can transfer your Prop 13 assessed valuation of your old home to a new replacement property, and you can do that up to 3 times throughout the remainder of your life. So if you're 55 years old, you're selling your house and you're going to buy a new house. If the house that you're selling has an assessed valuation of $500,000, you're buying a new house for $900,000. Instead of that new house having a $900,000 value, you can transfer the $500,000 value from your old home to apply to that new home to lower your tax bill significantly. And if you're over 55 or older, you can do that up to 3 times throughout your lifespan. So we make these slight changes to Proposition 13. Sometimes we've limited it, sometimes we've expanded it. But the basic rule here is it's the welcome stranger in that it gets reassessed when it changes hands. Now, we also had an initiative back in 2020 that would do what we call a split roll. There was a split roll initiative where we would treat business properties separate than single-family homes. That real single-family home property, subject to Proposition 13, but business property is as well. The split roll initiative would separate it so that business property would no longer be subject to the protections from Proposition 13, but single-family homes still would have that protection. That split roll initiative went down to defeat in 2020. It's probably coming back again in the future. I know the California School Boards Association is planning on bringing it back, I think in 2024, to try it again, to separate out single-family homes from business type of property. But Proposition 13, when it was passed by the voters in 1978, was a whole-scale revolution. And that's what was known as the property tax revolution. And Proposition 13 then served as the inspiration and the guide for a lot of other property tax revolts in other states that passed similar types of propositions. Example is up in Massachusetts, I think they have what they call Prop 2.5. The state of Ohio has what they call House Bill 920. So a lot of other states follow the course of action California did with Proposition 13. But again, the major change for local governments for Proposition 13 is Proposition 13 severely limited the overall amount of property tax revenue that local governments could generate. So they had to find something else to replace that revenue. Where they went is they went to user charges, user fees, more non-tax sources of revenue to diversify their revenue portfolio to replace that lost property tax revenue. So how does the property tax revenue fare and compare to our evaluative criteria? Burden distribution is very much an ability to pay tax because it's a wealth-based tax. We are calculating your wealth as the value of your home. Again, the problem there for equity is it tends to be a very regressive type of tax, in that if there's a big disconnect between the value of your home and your annual income, then you're going to be paying a large property tax bill without a whole lot of ability to pay that bill. It also violates horizontal equity, as we said before, because it's not treating similar properties in a similar way in terms of their tax liability. It is a very adequate type of tax, and local governments have relied historically on the property tax because it does generate a lot of revenue. It tends to be a relatively collectible tax, but it depends on how the property tax is paid. And if you're a homeowner, you know that there are 2 ways. One way is you can pay your property tax bill directly, and you get a property tax bill twice per year. You pay that bill twice per year. Or you can have it rolled into escrow, which means it's rolled into your mortgage and it becomes part of your mortgage payment and your mortgage company pays your property tax bill for you through the escrow account that they maintain to pay that bill from the payments you make every month to your mortgage company. Obviously, if your property taxes are escrowed, it's a much more collectible tax because it's being collected by mortgage companies, and there are fewer of those than homeowners. If you don't have it escrowed, then it's up to you as the homeowner to pay your tax bill. And so it becomes more taxpayer active and becomes less collectible at that point in time. In terms of economic effects, property taxes are relatively well insulated from economic fluctuations unless you have a huge bottoming out of the housing market. When the housing market, the bottom falls out, then home values go down. As home values go down, then county assessors' offices will probably go back and reassess some of those values down to protect taxpayers, and then you'll have less property tax revenue coming into government. But for the most part, compared to income and sales taxes, it's better insulated than those other two types of tax sources. Then we have our second type of taxation, which is the income tax. As we know, the income tax is used primarily at the federal level as well as by the majority of states. In some states, local governments also have access to the income tax. So that's not something we do here in California, but a lot of states allow their local governments, their cities, to have access to income taxes. In some states, they allow school districts as well to have access to the income tax. The income tax is viewed as a fairer tax by taxpayers, and we always have these surveys that are done where we ask taxpayers their most preferred and their least preferred type of tax. The most preferred type of tax tends to be income taxes. The least preferred tax tends to be the property tax. That's because people view the income tax as being a more progressive and a fairer system because of the marginal tax brackets. Both at the federal level as well as here in California, we have a graduated marginal income tax system, which means that you pay a tax rate that corresponds to your income level. And you pay your taxes based upon your adjusted gross income. And your adjusted gross income will then show you what percentage you are then paying in that graduated tax system. This is a year or two old, but this is what the federal income tax brackets used to look like. And you'll see for different filing categories, whether you are single, whether you are a head of household, a married joint, filing jointly, head of household, depending upon your income level, here are the relevant federal income tax rates. And again, it's a marginal type of tax system. So if you're a single individual, and again, these numbers are a year old, but if you make up to $9,875, all that you make up to $9,875 is taxed at the 10% level. Then every dollar above $9,875 up to $40,125 is then taxed at the 12% level. Then every dollar above $40,125 up to $85,525 is then taxed at the 22% level, and so on and so on. And so you're not paying your entire income at your prevailing tax rate. So if you're making $518,400, you're not paying all $518,400 in adjusted gross income at the 37% level. The first $9,875 is at 10%, then the next increment's at 12%, and so on and so on. And so again, it does shield taxpayers, and it also allows taxpayers to see it as being a fairer, more progressive type of taxation. Those percentages go up as your ability increases as well. Same type of thing here in California, another graduated marginal income tax system. Then in addition to having a marginal graduated income tax system, we also have a series of circuit breakers that we use in order to lower the tax liability for our income tax payers. One example of a circuit breaker will be deductions. If you do your own taxes, you're very familiar with things like deductions. Deductions are there to adjust for your filing status. So you'll have a different standard deduction if you're single, if you're married filing jointly, head of a household, married filing separately. You'll have different standard deductions. In the Tax Cuts and Job Act, I always get it wrong, in 2017, the Trump administration, we greatly expanded the size of the standard deduction to try and get more people to claim the standard deduction. If you own a home, chances are you're going to itemize your deductions because you have a deduction that you can take for the interest that you pay on your home mortgage. And so if you've got a home mortgage, you're probably going to be itemizing your deductions. If you have medical expenses, high medical expenses, you're probably going to be itemizing your deductions. If you have a lot of charitable donations that you make, you're probably going to itemize your deductions. Itemized deductions are there to try and encourage certain types of behaviors. So we want to encourage people to donate to charity. So we allow their donations, the value of their donations, to be deducted from their income level to lower their tax burden. We want people to purchase homes, and so we allow them to deduct the interest that they pay on their home mortgage from their tax liabilities. It also allows us to tax people's net income as compared to their gross income, because these deductions will then come off of your adjusted gross income. So you take your adjusted gross income, you subtract your deductions, and then you have a lower amount that you have to pay taxes on. Historically, we used to have exemptions as well, and exemptions were there to adjust for family size, the idea being that it costs more money to maintain a household of 6 people as compared to a household of 1 or 2 people. Those exemptions went away in 2017 in exchange for the larger standard deduction. So the purpose was to try and push more people toward taking the standard deduction because that's an easier filing form and it just makes the whole filing process a lot easier than itemization. Deductions are powerful tools to lower your tax liability, but they're not as powerful as tax credits. True tax credits are different than deductions in that deductions will be subtracted from your adjusted gross income. So if you have an adjusted gross income of $50,000 and you have $10,000 in deductions, then your tax liability is going to be based upon $40,000. A credit comes off after you've calculated your tax liability. So it does not come off of your adjusted gross income. So you'll calculate my tax liability is $5,000. I have a tax credit for $3,500. 5,000 minus 3,500. My tax bill is now only $1,500. So since credits come directly off your tax liability, they have a much more powerful effect than a tax deduction would, because the tax deduction only comes off of your adjusted gross income. So let's see, Jay says, why aren't renters allowed to use their monthly payments in the same manner as mortgage payments for tax purposes? It's a good question because if for renters, make no mistake, renters through their rent, I mean, they're paying the property taxes of their landlords, and so landlords, they're going to pass those taxes right along to their renters. I think the whole idea is that you want to encourage people to transition from renters into homeowners, and so allowing homeowners only to subtract this from as a deduction, that then gives them that incentive to move from renters to homeowners. I think it's all to encourage that behavior, trying to enhance home ownership. Again, we can make an argument. I think here in California, you can certainly make an argument about the value of home ownership, and is that really something that you have to really try and promote, especially in a state like California, and a state with such high rents. Should there be some concessions that are given to renters as well? And I would think there should be, but unfortunately there's not, because we want to encourage people to purchase homes. Or at least historically, that's been the argument behind it. So we have deductions and credits primarily as circuit breakers to reduce the income tax liability for our taxpayers. But circuit breakers are not a panacea. There are problems with circuit breakers. There's a lot of confusion. Whenever you use a lot of circuit breakers, like a lot of deductions and a lot of credits, it causes a lot of confusion in terms of it makes filing taxes much more difficult. The income tax code is literally thousands upon thousands of pages in length. If you file your own taxes, if you itemize, you know that the smallest nuance in something that you do or a way you earn your income can really make for a very complicated filing process. So it creates a lot of complexity and a lot of confusion. We've also, until very recently, been very bad at what we call indexation. We need to index those deductions and those circuit breakers to keep up with the changing value of money. So if you're going to say we're going to give you a $1,500 deduction for this in 1975, the $1,500 deduction today is worth a lot less than it was in 1975, unless you've increased that amount to keep up with the changing value of money. And Congress has been notoriously bad at doing indexation of these circuit breakers. And so a lot of them are out of date and not having the positive effect that we want them to have. Then there's this other thing known as the alternative minimum tax. The alternative minimum tax was originally designed to make sure that everyone pays their quote unquote fair share in income taxes. So it was designed to make sure that people at upper income levels that had a lot of deductions that they were able to claim would not be able to claim all these deductions and end up paying nothing in income taxes. So they would have to be subject to an alternative minimum tax, meaning that once their income level goes above a certain threshold, they would no longer be able to claim the same deductions that people at lower income levels were able to claim. Now, clearly that has not worked all that well, because we hear all these stories about upper income individuals paying lower effective tax rates than people at lower income levels. And what the alternative minimum tax ended up doing is it ended up, as salaries went up and as wages went up, it started ensnaring more and more middle and lower middle income taxpayers. So you were not just targeting the top 2 or 3%, you were getting 50, 60% of taxpayers who are now being subjected to this additional alternative minimum tax. So again, in 2017, as part of that piece of legislation, we changed the alternative minimum tax to try and make sure that it would just target upper income individuals and wouldn't be hitting these middle income taxpayers. So we did make those types of changes, but still today, there are a lot of upper income individuals who are getting around the alternative minimum tax because of all the nuances and complexities in the income tax code. So even though it's designed to be a very progressive system, you can certainly make an argument that it's not nearly as progressive as we oftentimes like to think that it is. We also have payroll taxes that are related to income taxes, in that you pay payroll taxes to fund Social Security and to fund Medicare. There's a Social Security payroll tax of 6.2% for your first $140,000 of income, and a Medicare payroll tax of 1.45% for your first $140,000. Now, for every dollar you earn above $147,000, then there's no Social Security or Medicare taxes that come out of that money. It's just up to your first $147,000. So if you work for multiple employers, little tax tip, if you have multiple employers and you're making more than $147,000 altogether, you're probably going to be owed a refund of some of the Social Security taxes that other employers took out, because other employers aren't going to know how much you made from another job, and so they're going to automatically take out Social Security, even though your overall income may be above the $147,000 amount. But again, that's to fund the Social Security Trust Fund as well as the Medicare Trust Fund. So those are what we call payroll taxes. Those are going to come out automatically. There's not much you can do about those. You can't really change those. Those will come out of your first $147,000 of income. I know we're running along. So the income tax in comparison to our evaluative criteria for taxation, the income tax of burden distribution, clearly it's an ability to pay tax. And your ability to pay is based upon your adjusted gross income. In terms of equity, the marginal tax brackets give taxpayers the impression of progressivity. It looks like a fair tax, but again, because of all the nuances and all the details in income tax law, the reality is it's not always as progressive as we would like to think that it is. Adequacy, it's a very adequate type of tax. The federal government gets the vast majority of the revenue from federal income taxes. States rely upon state income taxes as well for a lot of their revenue, and in some states, local governments augment their revenue with the income tax. It's a very adequate type of tax. In terms of collectability, it depends. When it is taxpayer passive, such as in terms of withholdings, it's very collectible. However, come April 15th, when people have to actively declare their amount of income and declare their tax liability, that becomes much more taxpayer active. That's when it becomes a little bit less collectible in nature. Economic effects: increasing income tax rates could distort what we call the work leisure preference of citizens. So if you increase your income tax rate, then it may go up to a level where it doesn't benefit people to work more. And they won't work that overtime because they're going to lose that money because it's going to put them into a higher income tax bracket. So it can have an effect on economic patterns. The two-way street is, how does the economy affect income tax revenue? Obviously, when you're in poor fiscal times, you have people who are unemployed. You're going to have less income that you can tax, so therefore less federal income tax revenue. Jay asked a good question in text channel. Why don't they just remove the $140,000 limit? I think that's a good question, and that's a question that Congress has been working on. And there have been calls to increase that by $10,000 or $20,000. Every year they do increase it. It used to be, I think 2 years ago, it was $129,000. It's been increased to $147,000. And now there are calls to just do away with it altogether. And by doing away with it altogether, you'll generate more Social Security revenue that could then help bail out Social Security in the future and add to the solvency of Social Security. I think you're right, Jay. I think that there are political explanations for why that does not happen. Lobbying certainly could be one of those explanations. I think that it's going to be a difficult sell when you have such an evenly split House and Senate. It's going to be a real difficult sell. Now, if you had a little bit more one-party control, I think that you would have an easier time with it. But I think you have a whole lot of opposition from the minority party, especially since they are so close to being in the majority right now. So politically, it's probably not going to happen, but I think it would probably contribute to the solvency of Social Security. So it's a good suggestion. It's a suggestion that Congress kicks around all the time. So that's our income tax. Again, income tax used primarily by the federal government and primarily by state governments as well. But the property and the income tax are both ability to pay types of taxes. Then you've got your consumption-based taxes, sales taxes, which are benefits received principles. So you're going to pay the tax based upon the benefit you are receiving from consuming some type of a good. The two basic categories of consumption-based taxes are general sales taxes and then specific taxes known as selective excise taxes. General sales taxes, as their name suggests, will apply to all transactions of all commodities across the entire economy, for the most part. So a general sales tax will apply to all transactions, or the vast majority of transactions. A specific sales tax, like a selective excise tax, will apply differently depending upon the good that's being transacted. So an example of a selective excise tax could be something like a luxury tax, like a yacht tax. So with a yacht tax, we say we're going to target upper income individuals because it's going to be those upper income individuals who are purchasing the yachts. So we'll apply a tax to the value of the yacht. Well, the problem with that, obviously, is that yes, you're taxing those upper income individuals, but if you tax them too much, they're going to stop purchasing yachts. So the demand for yachts go down. As the demand for yachts goes down, then there'll be less call for supply of yachts. And so therefore shipyards will build fewer yachts. The people who are building the yachts in the shipyards are not from those upper income levels. They're going to lose their jobs and they're going to be hurt by that luxury tax. So you have to think about the externalities. You have to think about the trickle down throughout the economy of these types of selective excise taxes. The other category of selective excise taxes are sumptuary taxes. Sumptuary taxes are sin taxes. And so taxes on alcohol, taxes on tobacco. We funded a lot of our sports stadiums with taxes on tobacco products. Sin sumptuary taxes are usually sold on the basis of we can generate a lot of revenue. At the same time, we can reduce some quote unquote socially undesirable activity. So we want people to consume less tobacco products. So we apply a tobacco tax. Drives the price up, reduces demand, people consume less tobacco, you'll have a healthier environment, you'll have healthier population, but If people are consuming less and you're achieving that goal, you're probably not going to generate more money. So it's kind of a hypocritical type of argument to say we're going to get a lot more revenue, but at the same time, we're going to depress consumption. Those two things don't work together very well. Another type of selective excise tax is a benefit-based excise tax. Great example of that is the motor fuels excise tax, or commonly known as the gas tax. Gas tax is in the news today because there have been calls at the federal level to suspend the federal gas tax. Here in California, there's a call in the state legislature to suspend the increase in the state gas tax that is due to go into effect on July 1st because of the high price of gas already. But what we do, it's a benefit-based excise tax because we take the motor fuels excise tax profits, we put it into the highway trust fund, and we then earmark that money to then be used for the construction and the reconstruction of roads and highways. So it's being used to pay for that benefit that people get for driving on those roads and those highways. Now, for the most part, consumption-based taxes like sales taxes tend to be highly regressive taxes. They're highly regressive taxes because people have disposable income. People from upper income levels have more disposable income than people from lower income levels. Disposable income is the amount of income left over after you purchase the staples of life. So after you've purchased your food, your clothing, your shelter, your pharmaceutical medications, once you've purchased all the staples of life, whatever you have left is disposable income. People at lower income levels have less disposable income than people at higher income levels. So unless you exempt the staples of life from your sales tax, then your sales tax is going to be regressive, and it's going to hurt those at lower income levels more than at upper income levels. So most states will have circuit breakers like commodity-based exemptions, where they'll exempt food, certain types of food. They'll exempt up to a certain amount of clothing. They'll exempt prescription pharmaceutical medications, again, to try and make the sales tax a little bit more progressive in nature. Now, in Europe, they have what they call value-added taxes, or a VAT. And there have been calls here in Congress, every single session of Congress, there's a call for thinking about adding a value-added tax, a VAT here in the US. The idea behind a value-added tax is it's a different type of consumption-based tax, whereby at each stage of the production process, there is a different tax incident. And so whenever a product goes from the raw material phase to the manufacturing phase, it increases in value. And when it increases in value, you add a tax. So that manufacturer will pay a tax. Then when that product goes from the manufacturer phase to the wholesale phase, it increases in value again, the wholesaler will pay a tax. When it goes from the wholesale to the retail phase, it increases in value again, the retailer pays the tax. Then when it goes from the retailer to the consumer, it increases in value again, the consumer pays the tax. The idea is that because you have multiple incidents of taxation, then you shield your consumer from paying all the taxes. Fact of the matter is that doesn't happen. And we know there's a process known as burden shifting. And the phenomenon when you get into taxation is burden shifting, that people always want to shift the burden onto someone else. Sin taxes are very politically appealing because people can shift the burden onto someone else. If I don't consume tobacco products, I can shift the burden onto someone who does. If I don't drink alcohol, I can shift the burden onto someone who does. Well, it's the same thing here. You can shift the burden through the production process. So the manufacturer will just charge the wholesaler more, who will then charge the retailer more, who will then pass along to the consumer. So value-added taxes really don't shield your consumer very well at all. So we don't have VATs here in this country. European countries use them very frequently. Another area of sales consumption taxation that is a really hot topic today is taxation on internet sales. Now, traditionally, and this has changed very recently with a recent case called the Wayfair case, but traditionally, if a state was going to tax internet transactions, the only transactions they could tax were transactions conducted by a seller that had a physical presence within the state. So if you're a Californian and you're buying something online from a company that has a physical presence in Indiana, but did not have a physical presence in California, California was unable to apply the California sales tax rate to that purchase from that Indiana company if it was done online, because there is not that nexus of a physical presence. That standard was established way back in 1992 in this case called Quill versus North Dakota. Because it was 92, it actually predated online transactions. It was a mail order type of business. And Quill Corporation was a stationery company. It was located in the state of Minnesota, and it was engaging in mail order sales. And you had citizens in North Dakota who were making purchases from Quill. Well, the state of North Dakota wanted to apply their sales tax to those transactions. Quill Corporation said, you can't do that. We're not located in North Dakota. We're a Minnesota company. And the Supreme Court agreed. There was no physical presence. Then, I think it was like 2 years ago, there was a South Carolina versus Wayfair case where the Supreme Court overturned that precedent. And the Supreme Court in the Wayfair case said, there's no longer the need for a physical presence nexus, and that states can apply their sales tax irrespective of whether or not the seller has a physical presence within the state. Now, even before the Wayfair case, even when you ostensibly were protected as a Californian from paying the sales tax if you had a transaction with an Indiana company, state of California would still get you, because every state that has a sales tax also has what's called a use tax. A use tax is a tax that's placed upon the value of consuming a good within the state. So you buy something from an Indiana company, they ship it into California, and then you consume it within California. When you consume it within California, you're getting a benefit from consuming in California. So therefore, you are technically responsible for paying a use tax. When you file your California state taxes, you'll see there is a question on your tax form asking if you brought any goods into and consumed them within the state of California. If so, then you are responsible for the use tax. States know that no one pays the use tax. I did a study years ago where I looked at 5 states and I looked at their ability to collect the use tax, and compliance rates with the use tax were less than 0.0001% of the tax liability owed, because it's all based upon a taxpayer actually declaring this tax and remitting this tax directly, and people just typically do not do that. Yeah, it was. I think it was 3 years ago, I believe, is when the change happened. So it was the last administration. And yes, it does. It costs consumers more money, but it then also allows state governments to tap into tens of billions of dollars of unrealized sales tax revenue by being able to tax those types of transactions. But the practical impact of it was actually a little bit less than that, because for many years after the Quill versus North Dakota case, states have been working to come up with a way to allow themselves to tax online sales. And it was something known as the Streamlined Sales Tax Project. So states joined together in the Streamlined Sales Tax Project to come up with uniform legislation that would allow them to tax remote sellers. They were successful enough to convince some of your major retailers, and so companies like Target and Walmart, Sam's Club, those major retailers actually agreed to participate in the project, whereby they voluntarily started collecting tax revenue from citizens that lived outside the state where they had a physical presence nexus. And so people are already paying a lot of these taxes to begin with, even before the Wayfair case decision was handed down. And so right now, states are starting to enjoy a windfall of tax revenue that's coming from online transactions. I know we need to wrap it up. We have about 5 minutes left. So the sales tax relative to our value to criteria of taxation, like we do with all of our taxes. In terms of burden distribution, just to recap, it's a benefits received principle. You pay the tax based upon the benefit that you get consuming that good or that service. If you don't purchase the good, you don't get a benefit, you don't have to pay the tax. You don't purchase that candy bar, you don't pay a tax on that candy bar. Equity, the sales tax tends to be highly regressive because of the disparity in disposable income between wealth levels, income levels. unless you got those commodity-based exemptions. If you have the right set of commodity-based exemptions, then you can make it a little bit more progressive in nature. And I don't know if I provide it in our beach board site, but in the past, I provide the California commodity-based exemptions. I think it's like a 47-page document or something like that that lists out all the different commodity exemptions we have from the California sales tax. Adequacy of the sales tax tends to be very adequate, especially in healthy economic times, and that's why state governments rely very heavily on the sales tax, and local governments also also have local option sales taxes. We're familiar with that in LA County. We know we have one of the higher local option sales tax rates in the state of California. Not the highest, but certainly one of the higher ones that then has that price effect of increasing prices for residents in LA County. Collectability, the sales tax tends to be very collective because, again, it's collectible through vendors, and there's a smaller number of vendors than you have taxpayers. And vendors oftentimes get an administrative overhead cost, so they'll get maybe a 1% return on all the sales tax revenue they're collecting as an incentive and inducement to do a good job collecting that sales tax revenue. Economic effects, I think you can make the argument that the sales tax is the least well-insulated form of taxation from economic fluctuations. The economy goes down, sales tax revenue is going to go down as well. But the sales tax also then has the impact upon the economy because you raise your sales tax too high, you raise the prices too high, it will then depress demand and consumption of those types of goods. It's your basic Laffer curve that you can draw, where as you increase your sales tax rate, you get more and more sales tax revenue until you hit a critical point of mass where you have raised your sales tax rate so high that people are no longer willing to pay that price. And if you keep increasing your sales tax rather than the amount going up, it then starts to go back down again. So it does have those types of impacts upon your economic activity. So those are property, income, and sales taxes. Again, the three main sources of tax revenue that we see governments use here in the U.S., along with their advantages and their disadvantages relative to these 5 different evaluative criteria for taxation. As we said before, as a result of Prop 13, local governments in California are much less reliant upon the property tax, much more reliant upon revenue from non-tax sources, things such as user charges and user fees. And next week when we get together, we'll start class off talking about user charges, user fees, differences between them, and how user charges and user fees work. We'll also talk a little bit about monopoly-based revenue sources such as utility revenue, lottery revenue. Then we'll do intergovernmental fiscal relations and revenue from intergovernmental sources. Wrap it all up, and we will then be done as of next week. And I did that all before 8:45, so we are still on time. Any basic questions? I know we've had some questions and good discussion in text chat. Any other questions or anything before we leave it here in our last couple of minutes tonight? Stop the share. Okay. Please do remember you have your 4th Beach Board essay that's due on Sunday, as well as the post-instructional assignment. As you're working on that post-instructional assignment this week, if you have any questions at all or run into any difficulties, as always, shoot me an email. I'm happy to talk you through them. I think it's a pretty straightforward assignment. And when you do part 2 and you're working on that budget, it's kind of trial and error. And so you're going to be going through and trying different scenarios and seeing which scenario works best. Just make sure you provide a good justification for any of the cuts that you're making to get down to your targeted budget amount. But feel free to email me any questions that you have. Otherwise, I wish everyone a very good week, and we'll be back at it one last time on Monday, and then we'll wrap up the class next Friday on July 1st. All right? Thanks, everyone. Have a good evening, and I'll talk to you again next Monday.
Thank you.
Thank you.